Welcome, everyone, to today's presentations. We're very pleased to have you here. My name is Randy Packett. I'm the founder and CEO of Chesapeake Capital Management. I'm confident you will benefit from the information I provided you today. I look forward to getting to know you. If you decide after the presentation and you'd like to get to know us, please make an appointment with us. We will be presenting a lot of information, and the information should take about 30 minutes. That includes questions and answers. So if you have any questions, please use your mouse to guide yourself down where it says a Q&A and type in your questions, and I try to get to that as much as I can. If for some reason I don't get to your questions, we'll be answering that by either sending you an email or we'll make the phone call to you. To help you with the note-taking, I have used this presentations and PowerPoint, so you certainly take notes on that based on what you read. So I hope that I could share some good information with you today. Before we get underway with this, here are a few points I'd like to bring to your attention. Our securities and advisory services are offered through Chesapeake Capital Management. We are a member of FINRA and SIPC, and we are a registered investment advisor registered with the state of Maryland. This workshop is for informational purposes only. So all the tax and legal advice that you like to get, you should be talking to your CPA or your attorneys. And any investment you have involves a risk, including possible loss of principal. So if you could continue to read that to the bottom of it, you see our disclosures. Let's get started with the tax history a little bit. I don't know if you're aware, but the first income tax was proposed in 1814 to help fund the War of 1812. But the tax never happened because the Treaty of Ghent ended the hostilities in 1815, which meant the U.S. no longer needed the extra revenue. The first income tax that went into effect happened after the President Lincoln signed the Tax Act of 1862. This law set 3% tax rate on incomes above $600 and 5% on incomes above $10,000. Following the Civil War, the public began to lose interest in income taxes. They just didn't want to pay it anymore. There were several attempts were made to make this act permanent, but he failed. So the taxes did not happen. Then the 16th Amendment was ratified in 1913, giving Congress authority to tax American citizens' incomes. Tax rate have fluctuated over time, as you're probably aware, and has the income the federal government received from taxes. Individual income taxes account for about 50% of our national revenue. So there's a lot of money they're collecting right now. If I could take you back, starting in 1915, where the marginal tax rate was only 7%. But then the war started. So after the War II, in 1945, the highest tax rate was 94%. I couldn't even imagine if anybody was making a lot of money and paying 94% back to the government, but that's what it was. And then going to the 1985, it was about 50% at the highest rate. 2015 was 39.6%. And some of you may know from 2016 till now is 37%. But you're probably hearing the tax rate may go up. And my understanding is they are talking about the rates going up all the way up to 39.6% again. More importantly, they're thinking about and talking about raising the capital gains from 19.1% of the average of capital gains tax to 27.7%. And the marginal tax rate on capital gains from 22.4 to 33%. The biggest thing is not just proposing for capital gains on the investments that you're aware of, but they're trying to take away the step-up basis. So, for instance, if you purchased a home started out with 200,000, now it's 500,000. And if you pass on, your kids don't have to pay any taxes on that currently, because the tax base will be the day of your death, whatever the value of your home was or your investments. But if they take that away, all the gains you have, your kids have to pay taxes on it. So I hope that doesn't happen, but you're also aware that how much money we owe. We're up to 27 plus trillion dollars, and they're talking about adding even more each day. So just going over some fun information that I'd like to share with you. As I already said, we have usually get about 3.5 trillion to 3.7 trillion dollars generated as our country's revenue, and 50% of it is from individual income tax, 36% is a payroll tax, 7% corporate income tax, 3% from excise tax, which is from taxing you on gasoline, cigarettes, travel, and 5% is other revenue such as estate and gift and custom taxes. So that generates about 3.5 to 3.7 trillion dollars, which accounts for 16.3% of our GDP, gross domestic product. Federal spending using this 3.5 trillion, that's just not enough to pay our bills. We are spending typically about 4.5 to 5 trillion dollars. This is way before COVID. Obviously, with COVID, we already have spent 3 point some trillion dollars, and they're talking about adding on another 1.9. It's pretty scary because we'll be way over $30 trillion in the next year or so. Out of that 3.5 to 4.5 trillion that we need to run the country, 29% of it, which is about $1.3 trillion, goes to Social Security. 22% goes to Medicare. 12% goes to Medicaid and Affordable Care Act. So when you consider that, just those three areas, Social Security, Medicare, and Medicaid, accounts for over 63% of our revenue. We spend that as expenses. And our defense spends 6%, non-defense 4%. And here's the biggest scary thing, because this will affect our tax strategies. 19% of our revenue that our country generates goes towards the interest that we have to pay. This is currently, we're very thankful the interest rate's low, but I can't even imagine if the interest rate starts to go up, how much money that we have to pay back. So individually, any Americans who earn more than $200,000 per year, that's about 4.5% of the tax returns that are sent in, paid nearly 60% of all federal income taxes. Americans who earn below $30,000 per year, and there are 44% of the returns that are being sent in, so almost half paid only 1.4% of all the federal income taxes. And people who are making over $2 million but under 5 pays nearly 21% of all federal income taxes. Just some of the facts that I'm just sharing with you. Today's agenda is I'm going to try to cover as much as we can. There are 8 things listed here. Summary of the Tax Cuts and Job Acts of 2017. Roth Conversion for 2021, whether that's something that you should consider. Healthcare laws and your taxes. Type of distribution actions you may want to take in 2021. And where to put your money, not just the asset allocation. People just think about how to divide up your assets into different investment for diversification, but you also need to think about where you want to put that. We're going to talk about the gift tax exclusions, whether that's something that you should think about. We're going to talk about whether you should invest your money in Treasury securities or any of the tax-exempt municipal bonds, and giving appreciated assets to a charity. So we're going to try to cover as much as we can in all those areas. So let's talk about the summary of the Tax Cut and the Job Act of 2017. During this time in 2017, when the law was changed, they raised the standard deductions and they eliminated personal exemptions altogether. For someone like me, back in the days when the kids were staying home, my wife and I, we had 4 kids. So there were 6 personal exemptions that we were able to take in tax when we filed taxes, but that's taken away. But fortunately for me, kids have grown up and they have moved out. So we won't be able to get their exemptions counted towards our taxes anyway. But they have increased the standard deductions. So most of us, I know most of you who's listening are seniors or about to retire or getting to that age. And if you have your kids already moved out and you don't have a high exemptions, the personal standard deductions going up to double should really help you. They did cap the state and local tax deduction, which is also known as SALT deductions. They have capped that at $10,000. And they increased the child tax credit and expanded the eligibility so that more people could take advantage of that. But they did limit the mortgage interest deductibility. And if you are aware, the mortgage deductibility is only up to $750,000, the value of your house or the buildings. Anything above that, you won't be able to take deductions. They allow 529 plans to fund elementary and secondary education. Just keep in mind, however, if you had your money set aside in 529, and if you don't use that for education purposes, the money that you had set aside will be taxed at some point. So make sure to use that if you have a plan to set money aside for it. They also eliminated the ability to reverse the Roth IRA conversion. Most of you may not even know what that is. It's just a tax strategy that some people have used. Sometimes it's real good to consider moving the money out of your traditional IRA into a Roth IRA. Unlike when you're contributing to a Roth IRA has limitations of how much money you could put in each year. But if you do a conversion from a traditional, many of you have worked for a company or a government where you had 401ks, 403bs, TSAs, and TSPs or deferred comp. Any of those money, usually when you retire or about to retire, most people will move that out into individual IRAs. Once it's in an IRA account, you can convert the whole amount into Roth. And why would you want to do that? There's a huge tax benefit in the future if you were willing to pay the taxes now when it's low. And this might be a great opportunity for you to consider now, knowing that the future tax is going to go up. You may not take long. You may be this year, you may be next year, but certainly I am a believer in that where the taxes will definitely go up in the future. So if you think the tax will be too high in the future, you certainly want to consider conversions now, especially if you don't need the money anytime soon. They did raise the alternative minimum tax exemptions so that that's again, it's another strategy, whether how much deductions you could take in taxes. It's a little too complicated to go over this in a webinar. So if you have any concerns about that, I strongly recommend you making an appointment to sit down with us so that we could go over there with you. We could show you and help you to reduce your taxes, sometimes maybe even eliminating it. And also they doubled the state taxes exemption. Most of the people that I run into, except for 1 or 2 maybe, don't really have to worry about the estate tax. Some people call this a death tax. Once you pass on, you and your spouse, government wants to get a part of their money. But now the exemption amount is pretty high, so most of us don't have to really worry about that. Some of you also tell me about, what about the Maryland estate tax? Actually, in the state tax, it's called inheritance tax. Even that, our state has started to follow this federal government number, so that's pretty high there as well. Prior to last 3-4 years ago, it was only to $1 million. So anybody who had over 2 million, they had to pay the inheritance tax anywhere from 9 to 16%. But that pretty much is gone now, unless you have over $20 million as your total estate. So again, if you have any questions, we could certainly go over that and help you with that. We'd love to have an opportunity to talk to you about that. Let's kind of talk about some of the tax acts that went in. These will expire in some point. Individual tax rate and brackets, your standard deductions being double, and your personal exemption that's been taken away. But I don't think that's going to make any difference either way, because most of us have our kids have moved out. And $10,000 cap on SALT tax, that's the state and local tax deductions. Double child tax credit, estate tax exemptions, and individual alternative minimum tax. That all going to be reversed back, or it's going to expire in 2025. And then the corporate tax rate cut that went from 37% to 21%, repeal of alimony deductions, those going to be going away in 2027. But I don't think it's going to have to, you have to wait for that long, 2025. I'm pretty sure that we will have a different tax rates and different tax laws in next year or so. So it is very critical for you to really start planning what you want to do with your money, your investments right now. You know, sooner you start planning, the better options you're going to have, because you have more information to think about. So love to have an opportunity to talk to you. Let's talk about the long-term capital gains and how that's affecting people. This is what the numbers look like currently. Long-term capital gains for a single person, if you're making less than $40,400 in tax returns when you file, even if you have a capital gains, you will not pay any capital gains tax. If you're filing this jointly, you and your spouse, then the capital gains will be 0% as long as your total income, your AGI, is less than $80,000. If you happen to be having a lot of revenues and income where it goes to 445 for single files, usually you don't have too many people out there making that kind of money. But if you are, your capital gains goes up to 20%. If you're filing jointly, you and your spouse, once your income's above 500,000, then your capital gains is 20%. Most people are not aware of the long-term capital gains, that if you have certain income, that you don't have to pay any taxes. So that's the good news now. But certainly I already shared with you that tax is going to go up, and capital gains, they're going to try to make that into just regular income tax rate. And income tax rates they're talking about is going up to 39.6%. So it is critical that you plan on your investments in accordingly with the tax laws changes that's going to come up. One way to manage investment related taxes is to consider taking advantage of a tax deferral account. I know many of my clients have their assets allocated in some of the stocks and equity market, as well as some in annuity market. Some of you are believers in annuities and some of you are not. There are some good annuities and there are some terrible ones out there. So if you have certain feelings about that, a lot of times you may not be informed about the proper way to think about how the annuities may help you. For some people, it's the wrong investment. For some people, it's the best investment that you should consider. So just keep that in mind as you're planning to reevaluate your investments. Let's talk about how much money you're able to put away in retirements for 2021. If you're still working and you're able to put money away as a maximum amount, individually you could put away up to $19,500, whether it's a 401k, 403b, TSP. Those are the very similar animals. They just call it a different tax code. You're able to put away $19,500. But once you reach the age of 50, they allow you to put away more money each year, another 6,500. For those of you who's able to put away this type of money, you're able to put away $26,000 in any given year. And if you and your spouse is both working and you both companies or government offered you to put money away, that's a lot of money because stock away for your future. For those of you who doesn't have that and you don't have any sponsor 401ks or 403bs and such, then you may be able to put money away in an individual retirement account. The regular contribution limit for 2021 is still $6,000 per person. If you're age 50 plus, you could add another 1,000. So adding it up, you could put away as much as $7,000 a year. So if you and your spouse want to put away together, you could put away up to 14,000, providing you meet the guidelines of how you could take the deductions and taxes. Make sure that you understand there are limits of how much money you can make, and based on your income, how much money you could put away and take the tax deductions. So what determines the tax deduction phase out is based on your income, your filing status, and any other workplace retirement plan coverage that you may have. Some people will get 401ks or IRAs, and in addition to that, they may also consider putting money in a Roth IRAs. Even the Roth IRA has its own limits. It's a really good way of putting money away. In the past 5 years, many of the companies and government entities have allowed their employees to put their money away, not only in traditional 401ks and 403bs, but nowadays they have a Roth 401k and Roth 403b. We have 4 kids, and 2 of our kids currently, their companies offer 401ks, Roth 401ks and Roth 403bs. And, for the kids, a lot of times when they start saving money, they may not really know how that's going to save them in taxes. So as I have told my kids, and they're doing this, all my kids are putting their money into a Roth account. That way, when they reach the age of 59 and a half, every dollar they take out at that time will be tax-free. And there also will be no required minimum distributions when they turn the age of 72. So if your company or your kid's company offers that, either yourself or you could tell your kids to start thinking about putting money away. It's always good to tell and help your kids to manage their money, and they'll thank you if you shared that information with them today. Most of the younger people do not realize the real benefits of compound interest and not paying taxes in the future. So that's something that you may want to think about. What about the IRA rollover? Well, just keep in mind, there are very strict rules about this. Years ago, many people have put money in the bank. Today, most people do not put money in the bank because they typically do not pay high interest. But if you still have some of those IRAs in the bank and CDs that's coming due, and many of you, because of your own idea of diversifying and not putting all the eggs in one basket idea, so that you have put money into different banks and you may have multiple IRAs. If those IRAs come to you and you want to roll over into another one, you only could do one rollover per year. So if you got multiple IRA account and you want to roll them into something else, only way you could do that is having a direct transfer from one custodian to the next custodian. If you don't, you'll be penalized. You'll be paying a heavy taxes and penalty on it. So understand the rule. Make sure you work with someone who understands tax laws, when it comes to the rollovers, so that they could help you to make the proper decisions. Let's talk about the Roth conversion for 2021. Why is this thing important? Well, Roth conversion, first of all, is the money that you pay into the one that typically is a Roth account, is the money that you put in after taxes. But conversion is a little bit different. As I already said to you earlier about having your money from a 401k, transferring or rolling into an IRA account, once you have that, your traditional IRA account is still qualified tax defer account. I say the word tax defer for a reason. You first did not pay any money, taxes onto it, any growth you didn't pay taxes. So every dollar you take out from a traditional IRA or 401k is taxable. Well, here's the idea of paying less taxes in the future. You will still pay some taxes now, but I can assure you taxes you pay today will be much less than you would in the future. Here's an example. Let's assume that, again, it could be you and your spouse, total defer 401k was $500,000, 250,000 each. Or you could be just 250, but I'm going to use the number $500,000 for simplicity illustration here. If you had traditional 401ks, it was a roll into a traditional IRA, you don't pay taxes when you do that. So let's say you got $500,000. If you decide to take that money and convert that to Roth, which I wouldn't recommend doing all at once, because if you convert the whole 500,000, that year you got to add that 500,000 to your current income as taxable income, which will bring your total income above the 450, which in turn meaning that you're paying not only in heavy taxes at the highest rate, but you also will be paying the excise, the extra Medicare tax, Medicare surtax. So a lot of times people may want to convert $100,000 each year, next 5 years. So if you are typical income now and you're in the 50s and you're working today, let's say your income is, you and your spouse is 150,000. If you convert 100,000 of the $500,000, then that 100,000 will be added to the 150. So your total taxable income for this year will be 250. Why would you want to do that? A lot of people, especially if you talk to some of the accountants, they're going to tell you not to do that. Part of the reason is they're trained to try to save you money in taxes. They were trained when they were going to school, they were taught to defer taxes as long as you can. Certainly, that's an option, but you also got to plan for the future. And one of the best idea is if you were to convert that for the next 5 years, $100,000 a year, you may add additional 15, 20,000 in taxes that you have to pay today. Sometimes when you do the conversion and you don't have any money, you could take the money out from that account to pay taxes. So if you had 100,000, perhaps you roll over $80,000 into an account Roth, 20,000 will be sent to the IRS as taxes immediately. Or another option is you may have some money sitting around in the bank earning virtually no interest. If you got money sitting around 20 grand, 50 grand, 100,000, well, take that 20,000 sitting in the bank earning zero interest or 0.5%, use that money to pay for taxes so you have converted your traditional IRA for 100,000. You have a whole 100,000 go into a Roth IRA and taxes being paid through your savings. Some of you may or may not have this, but many of us, especially nowadays, have seen our value of your house have gone up drastically. And I would assume as long as they keep the interest rates low, the mortgage rates will be kept low, which means the value of your home is going to be going up quite a bit. My daughter just purchased a home about a month ago, and I couldn't believe how many people were bidding on the house. And usually nowadays in some good neighborhoods, they're paying 20% premium to buy the house that they could have gotten for a regular price about a year ago, because they know the price of homes are going up, so the equity will build up faster. So here's another opportunity for you to use the equity of your house. Perhaps you may want to use that for conversion taxes. And it will really help you, because if you pay taxes about 20% now, and you let that money grow for another 10 years, you're 50, so you turn 59 and a half or 60, or you're 60 years old, you wait till you're 70, your money with the proper investment returns might double. So $100,000 or $500,000 will become $1 million. But every dollar that you have in there, if it's a Roth IRA, you'll be tax-free. I know I'm going over a lot of numbers on this webinar, and you're not seeing the actual numbers on paper, but I would certainly love to have an opportunity to sit down and share that with you in person. And as I said, once you turn age 72, if it's a Roth IRA, there's no required minimum distribution. Whereas the traditional IRAs and 401ks, you must take the taxes out. As I mentioned the number, if your IRA account is $1 million and you're 72 years old, the amount of money you got to take out that year is about $37,000, whether you need it or not. You'll be paying taxes on that. That will be added to your whatever the income that you have that year. Whereas if you have a Roth IRA, even if you take the money out, you're not forced to, but if you are, you only pay 0 taxes on that amount. It's kind of funny, you pay taxes down a smaller amount and you gross double, and whatever the money you take out, you pay 0 taxes in the future. The rule is, as long as you keep it for 5 years, that's the strategy that you have to understand. Anytime you do a conversion, you got to keep that in for 5 years, and you have to be 59 and a half to draw the money out. It's no different than traditional IRA. So, and once you do the conversion, you cannot ask them to change that you want to go back to traditional. But no one really does that anyway. So I don't think that's a big changes in the tax law change. Okay. So what about giving money to a charity? Well, nowadays, I would recommend, if you are already donating money to a charity, rather than writing a check out of your checking account and taking a tax deduction, why not donate some of your appreciated stocks or bonds or mutual funds directly to them, so that any gains that you have, especially if they change the capital gains law, where the capital gains might go up from what currently as high as 20% to double 39%, or if they decide to make that into a regular income, you're going to be paying a lot of taxes. And if you are already giving money away to a charity, if you donate the money directly from appreciated assets, you don't have to pay any taxes in that. So that's another idea that you may want to consider. Same thing with your required minimum distribution. It's better to, if you don't need the money, it's better to have your RMDs go directly to a charity, and all the institutions that we work with, that they're able to send the check directly to them on your behalf, so that you don't have to deal with that from getting the money, paying taxes, donating it, and taking the tax deduction. So that's another idea. What about healthcare laws in your taxes? Well, as I already said to you before, we are paying into taxes. So when you're working, we have a thing called FICA tax. 1.45% of the 7.65% we pay in FICA goes towards your Medicare wages. That's your wage tax. But if you're a high earner, you will be paying 2.35%. Anybody the income's above 250 and married filing jointly, rather than a 1.65. So that's extra taxes that you may want to avoid if you're able to take some deductions or defer some of your money to keep your incomes below that. Once you get into the Medicare surtax rate, for someone making and filing jointly is over 450,000, then you have to pay 3.8% surtax in Medicare, and also an investment income. So again, understand that, you have to understand the numbers, and you have to understand your taxes. Whenever we meet with our clients, we ask them to bring in 2 years worth of tax returns, so we could see where you are, and we could see how we could help you to reduce your taxes. Sometimes by meeting with us, some of our clients will continue to pay taxes as they have done before. Some of our clients, because they have met with us and with the ideas that we have, have reduced their taxes altogether. Some of our clients are able to mitigate their taxes by moving some of their assets somewhere else. And then because of that, they pay zero Social Security taxes. So we may be able to help you there as well. And just remember, any medical expense that you have, if your medical expenses happen to be high, unfortunately, as we get older, time to time during our lifetime, we may spend a lot of money in medical expenses at some point. And in any given year, if you pay more than 10% of your adjusted gross income into a medical expenses, then you could take the deduction on anything above that. So keep that in mind. Let's talk about the distribution actions. Well, one of the things you must do is you got to take the inventory of all the potential sources of retirement income. So if you got multiple IRAs, multiple 401ks from previous jobs that you had, at some point when you need to take the RMDs, you must add up all the numbers to figure out the total required minimum distribution out of your qualified account. In order to pay less taxes, you need to start managing it today. Many times it's good to consolidate all your assets. Not every time, but many of our clients come to us and we're able to clear up a lot of their IRAs, 401ks, and laying it all over the place. So we'll be able to coordinate your assets so that you know how much RMDs that you must take out when you get to that age. As I already said to you before about the tax smart asset location, it's not just about diversifying your assets in any account, but where is that money? Who's managing it? So make sure that you sit down with the proper people with the proper licenses, someone who knows how to make the recommendation in your investments, and also someone who's able to handle that. Not everyone that you talk to is going to be licensed and also have the experience to help you with the managing your future money. So diversification and asset locations, it does not guarantee positive results. So it's important for you to really take a look at what you have and reevaluate, especially now the tax law is going to be changing very soon. Gift tax exclusions. While you really don't have a lot of people need to worry about this, but if you happen to have a lot of assets, you want to start giving it away, you're certainly able to give the money away. You could give away up to $15,000 in 2021 per person. So if in situations like me, if I had money and I want to give it away to my kids, my wife and I could give $15,000. Each of us could give it to each of our kids. And that amount will be accepted by our kids as tax-free. But if we decide to give them more than $15,000, let's just say for whatever the reason we want to give rather than $30,000 to a kid, if we give them $50,000, the difference between 30 and 50, there's a $20,000 extra. We have to pay taxes on it, not the kids who are receiving it. People who are giving the money have to file the gift tax form to the government, and we have to pay taxes on that. So just understand there are rules of giving money away. You can't just do that without thinking it through. What about Treasury securities and tax-exempt municipals? Well, obviously safe. I still believe the money in our country is the best and safest place to put it. But even though the rates have gone up slightly lately, all last year, the 10-year bonds were paying around 0.6, 0.7%. Right now, it's paying about 1.5. Who knows what the future might be, but I don't think you'll be happy earning a 1.5 or 1%, even if it's a safe area, because if the inflation's above that, and the inflation's been averaging about 2% for the last 5 years, and they're saying the inflation might go up to 4 to 5% next year. If it does, and you're only earning 1%, you're going to be losing the value of your assets, so that your purchasing power will go down. Whatever you're buying with the money today, you're going to be needing a lot more money to purchase the same thing. So think twice about putting money away in accounts like that. And also because of that, any money that's tied to Treasury, especially if you buy a 10-year bond, if the interest rate goes up in the future, the value of your account goes down, which means you're taking a risk of losing money. So understand how that works. And we already talked about the giving appreciated assets, but more importantly, giving money away for required minimum distributions. Well, before I close down, I have a few questions that just came in. So I want to read that to see if I can answer that for you. The first question I got today is, the date for filing taxes last year was pushed back to July. Is there any chance you will be pushed back this year? Well, the answer is yes. They're actually talking about that. I was just told this past week that the Congress is talking about maybe pushing that back as they have done last year. But as of today, they have not made a decision, which means you have until April 15th to file your taxes. And here are some dates that you may want to consider. April 15th is a tax filing deadline. If you ask for extension, if you request that and send that in, October 15th will be your date. But if you owe money, you still want to pay the money up front. Otherwise, they're going to charge you later on, not only what that amount is, but also they're going to add interest to that. So keep that in mind. And if you have any estimate income taxes you're sending in, the fourth installment from last year is due on January 15th. Obviously, that's over. By June 15th, you got to do the second installment. September 15th, third installment. So make sure you know the dates of when you need to send that in. Second questions. They did not require RMDs to be taken last year. Any chance that will happen again this year? Again, as of today, they have not done that. I haven't heard anything like that going around. They may push back the tax returns filings, but they're not really, no one's really talking about pushing back the RMDs, not needing to take it in 2021. Matter of fact, I was listening to Jerome Powell, who's our federal chairman today, and he was saying that he feels if the market, this COVID thing is handled within the next 3 to 4 months, he thinks that our GDP might grow as much as 6%. Well, if that happens, certainly they're not going to let you defer any of your RMDs. Number 3, is there any way I can put away more money for my retirement if I am already maximizing my 401k contributions? Answer is yes. But there's limits of how much money you could put away and where you could put that away. And not knowing your personal situation, you won't be wise for me to even attempt to tell you where to put that. But we certainly have strategies that we work with our clients to how to help you so that you pay less taxes now and also in the future. So if you have that, you may want to call us back, or maybe we reach out to you so we could get together. And the fourth and last one I'm going to take is, when should I start taking my Social Security and why? Well, again, that question is a very important one, but it's very tough to answer not knowing your personal situation. Here's a thing that I will tell you. I'm planning on working into my 60s until I'm age 70, which means that I'm going to work. So there's no reason for me to consider taking my Social Security early, especially knowing that my family, both sides, have a longevity. My grandparents both lived till the age of 98. So I know I'm going to live a long time, or the percentage is good that I'm going to do that. Therefore, I'm going to wait to take my Social Security. On the other hand, my sister, who's 62, she has taken the money now. She has never been married. She's by herself. She's retired. There's no reason for her to wait, because if something should happen to her next year, year after, 5 years from now, 10 years from now, if she did not take the money until she's 70, well, guess what? If she died at that time, she would not have collected any money, and she died with it, because no one else is going to get that. So in that situation, my sister, I would recommend her to get it. Myself and my wife, I'm going to defer mine till I'm 70. So not knowing your personal situation, you really need to consider that. For some people, you should take it early. For some people, it's best to wait. But there's a lot of moving parts, so we need to sit down and really go over what's best for you. So with that, I want to thank you all for joining us tonight. I really enjoyed doing this, and we're going to try to do this once a month. So please join us in the future. And look like it's going to be a beautiful day tomorrow. The weather's breaking, and I understand you may go up to 50 degrees. So if you're able, go out and enjoy the weather. Thank you, and God bless you. Bye-bye now.